Hello everyone, good evening. My name is Simon Barnard. I'm the fund manager for the Smithson Investment Trust. Now let me tell you a bit about the trust. It's very simple. When you buy shares in the Smithson Investment Trust, we make you money by buying small companies that become big companies. I'll just repeat that. We buy small companies that become big companies. That's it. Simple. As we've still got some time left, I'll give you a few more details. So there's the disclaimer that I'll leave for you later. Just to expand on that a little bit, we provide you access to a concentrated portfolio of the world's best compounding small companies. So there are a few elements here that are quite unique. Now, we buy small companies, but many fund managers who do that have a very long list portfolio. We have a very concentrated portfolio, around 30 companies. And we're able to do that because we only buy the world's best compounding companies. So by best, we mean very high quality companies, and we can have the confidence then, with the very high probability that they will become big companies, and concentrating our portfolio around them. Why do we think this is a good idea? Well, here are the words from the master himself, Warren Buffett. He says, firstly, I like to put meaningful amounts of money in a few things. He initially ran a very concentrated portfolio. And second, he constantly bemoans, if you have read or heard anything that he said, he bemoans the fact that Berkshire Hathaway, the company that he runs, has become so large that he can only invest in very large deals to move the needle on that group. But instead, when asked what would you do differently if you didn't have to do that, he says, well, it may be that the elephants we have to buy are not as attractive as the mosquitoes that are out there. He says he would buy small companies if he could. So our strategy is also very simple. We only buy good companies. We are extremely demanding about the quality of the company that we buy. These companies have to have fantastic products or services. They have to have very interesting growing niches. They need competitive advantages within those niches. They need high returns on invested capital, strong margins, excellent free cash flow, and importantly, a very long runway of growth ahead of them. Small companies only become big companies if they grow at a large rate for a long time. We want all of those things, and that is why when we look at our entire universe of 10,000 companies across the world, we've only found 30 that fit all of those criteria at once. The second point is, when I say we make you money by buying small companies that become large companies, we can only do that if we pay the right price. Great companies can turn out to be rotten investments if you don't pay the right price. So we are extremely valuation sensitive. Now, it's important to always remember that you get what you pay for. So high quality, growing companies are never going to be cheap. They're never going to be lowly rated. But the important thing is that you don't overpay for them. And then finally, we try to do nothing. And this is where the magic of compounding occurs. And we allow those companies that we so fastidiously researched, found, patiently waited for, added to the portfolio, and let them do the rest of the work. So how do we even prove to you that we only own good companies? Well, what we've done is we've amalgamated all of our company metrics into one number for each line. So this is the average of all the companies within the Smithson portfolio, the dark blue bubbles. And for some context, we've put that against our reference index, the MSCI Small and Mid-Cap Index. So first, the top line, our companies are definitely higher quality than the average. The return on invested capital, on average, for our companies is 26%. That is a high number, particularly when you look at the context of the average MSCI SMID company, which is only 8%. And to be honest, we haven't even included our highest return, which is actually now our biggest position, company, within that number because the returns are so high, it would skew the number and I felt wouldn't be representative of the whole. So the average of every other company is that. Important these days, our companies have great inflation protection. That is because they have strong gross margins. Roughly translated, at 62% gross margin, that means that our companies make something for the price of 38 and sell it for 100, keeping the 62 in between. Whereas the average in the index still sell it for 100, but it costs them 70 to make. Their cost base, on average, is much bigger than those for our companies, which, of course, when inflation comes along, their cost base is inflated much more than ours is, and those companies have to try to put up price much more than ours do. Quite often, don't manage to do so. Our companies, therefore, have higher operating profit margins. You can see 3 times that of those in the index. And most importantly, they convert very efficiently those earnings into cash. We don't care about accounting earnings. They can be fudged. They can be, even companies we look at have a myriad of adjustments to their accounting earnings. It doesn't matter. We just look at what cash is coming into the business, what cash the company generates, and what cash that company can keep investing to grow into a big company. And then finally, our companies are on average net cash. So we couldn't put a leverage number here. Instead, we've tried to pick something else. We used interest cover. But you can see by the minute size of the grey bubble, our companies at 61 times interest cover are extremely conservatively financed. But perhaps the most important number of all on this slide is that on the far right, because on average last year, our companies grew their free cash flow by 22%. That is another big number. And if those companies keep growing at 22%, which I already tell you they won't do year in, year out, but if they could do that, they will grow into very big companies in not too long a time. So how do we actually do it day to day? What are me and my team doing to research, find, and buy these companies? Well, it all starts with what we call our investable universe. This is the 92 names that we've spent now 8 years researching across the whole world, all the developed markets, to find all those companies that I've just described fit every single one of those criteria. So those 92 companies are all the companies we may one day buy in the future. They're the ones we've discovered that are good enough. However, we don't own 92, we own 32. So how do we get from the long list to the portfolio? Well, a few different ways. Mostly, obviously, it's valuation. I said earlier, great companies tend to be recognized as good companies by everybody else, so they're not cheap. Most of the difference between those two lists is valuation. We have to wait for the right valuation. And that can happen in a few ways. The second point is, a few of those companies, we don't tend to look at cyclical companies, but a few of them are cyclical, and we have to wait for the right point in the business cycle. Clearly, we've talked a lot about the US. There's no point buying a lot of companies at the peak of their cycle. There's also not much point buying companies that are heading down into the troughs of the business cycle. Clearly, we'd love to buy those just as they're coming out of the bottom. It's not easy to do. Sometimes we get it right, sometimes we get it wrong, but we do tend to wait a little bit for that business cycle to correct before we start owning that company for the long term. Or more specifically, per company, we have to wait for something to happen to that individual company. That's happened a few times in our portfolio. In fact, one of those was Equifax, which has been a great performer for us. Back in 2017, they had, so this is a US-based consumer credit company. They had an enormous cyber attack, and they lost consumer records. Now, that could have been devastating for that company. We didn't own it at the time. But within a year, they were starting to get back on their feet, rebuild their systems. And we suspected, which has turned out to be true, that they would eventually become the most cyber secure credit agency in the US, and they have indeed done so. So we entered the shares in 2018, and we've held them ever since. Not only has the business rebounded, but it's gone from strength to strength. And then finally, sometimes we get times, like in the UK, where everything goes on sale. We've given a few examples here of times that we've lived through since we launched in 2018. COVID is the most obvious one, where we got a chance to buy amazing companies that have been thrown out with the bathwater. Rationale is a great one. This is a German manufacturer of very high-end professional ovens. So this is the oven of choice for professional chefs around the world. Now, what better time to buy a professional oven maker when every restaurant in the world is closed? That we bought at 400 euros. It peaked at 1,000 euros a couple of years ago. It's now at about 900 euros. But this is a fantastic company. It's got, I said we like companies with great products. It's got an oven in both the White House and Buckingham Palace. It is the reference oven manufacturer. And Fortinet, this is a company, funnily enough, where we also bought just as we're coming out of COVID, but has done so well now, it is a big company. And we sold it. So Fortinet, during our ownership, went up multiple times, and we sold it just at the end of last year because we could no longer justify a company that had reached $70 billion in market cap within our small cap portfolio. It was fun while it lasted. Let's move on. Here, we've got the exposure both geographically and by sector. Now, we only really focus on a few sectors. And that's really down to the fact that there are only a few sectors in the world that, over long periods of time, which is what we're interested in, actually generate any shareholder value. You'll never hear me talk about commodity-based industries with highly volatile commodities, or regulated industries, or industries that require a lot of debt and leverage just to make an adequate return. Instead, you'll hear me talk about industrials, information technology, healthcare, and consumer. But really, it's not about the sectors either. It's about the individual companies. So here I provided, all of these companies are in the portfolio, and a few others, obviously. But I'll just touch on a few and then open it to the floor. So let's start with the one nearest to me, Oddity. This is a fascinating company, listed in the US. But it is one of the very few online cosmetics companies. Now, this is a company taking on a 100-year-old duopoly, but has found a niche, a small white space, where it can attack these companies because they don't bother to play. Now, in the cosmetics industry, it is extremely hard to sell cosmetics online to a new customer. That's obviously because people want to feel the product, put it on their skin, see if it matches. Now, selling refills to existing customers, that's easy. They just log on and buy what they already know. But selling to new customers is so hard because once they've got the product and they don't like it, they send it back and it's got to be destroyed. You can't resell it. So it's extremely expensive to get this wrong. For that reason, the duopoly in the cosmetics, obviously, is L'Oreal and Estee Lauder. They've been around for 100 years, and they haven't really had to care about this before. So there is enormous white space that Oddity is attacking by doing things differently. They started out as a data company. So they now have on their platform the details of over 40 million users with 2 billion data points. Now, using all of that data, they have been able to design algorithms and machine learning to mean that when you log on to their website, I've done it, my wife has done it, you take their quiz and accidentally provide them with another 50 data points, and they tell you at the end of that process, this is the product you're going to buy. There is no choice. So I did it, bought the product, put it on my skin, it matched perfectly. And they have discovered that using these algorithms, they get a 90% hit rate by which they measure the 10% returns. Now, what's so interesting about that is the traditional bricks and mortar way of walking into a Sephora in the US or a Boots in the UK and having an in-person beauty appointment with a trained beauty expert, where someone walks you through the options, you try it all out, they tell you how to apply it at home, importantly. They only have an 80% hit rate. The machines are beating the in-person appointments. Now, before I go on, does anyone want me to talk about another company they see there? Just shout it out and I'll repeat it. Just shout it out.
Moncler.
Moncler, okay. So Moncler is another good one. This is one that we, again, bought during a period of market distress in 2022. This is a company I'm very excited about because it is an extremely well-run business. So Moncler was ultimately bought out of bankruptcy in the late 90s. Now, many people with long memories might know Moncler as offering shiny puffer jackets in the 1980s. That didn't last very long. By 1998, they were going bankrupt. They hired a new chief director of design, Remo Ruffini. He thought he could do better than the current management, so he bought the company out and relaunched the brand in the early 2000s. It has been a fantastic success. He has reinvigorated not only the product, but the brand through extremely imaginative, impactful marketing. Now it is almost a household name. The reason we like it is obviously it's still quite small, but different again, in fact not too dissimilar to Oddity in a way. They are taking enormous market share from the giants of Louis Vuitton, Gucci, Hermes, because they are still small, they are still opening stores in new markets where they are growing. And at the same time, they are diversifying from their heritage product, which is outerwear, puffer jackets, to other categories like knitwear, shoes, accessories. And so in all of these areas, they are continuing to grow where others cannot. For most of the time that we've owned it, it's grown in the double digits. Now, you may or may not know that the luxury market currently is very difficult, partly because China is down in the dumps, partly because the US is now rolling over, and partly because Europe never really got off the floor. So luxury isn't doing well. We look at the numbers from Gucci, they're negative. We look at the numbers from Louis Vuitton, they're flat. We just got the results from Moncler, they're still up 7%. That's an incredible result in a declining market. So we think, have got a very long runway of growth ahead of them as they continue opening stores in new markets. One more. Fisher & Paykel. So this is a New Zealand-based company. This is a great company because, we talk a lot about diversification, and within 32 names, you can get diversification. While they're all small companies, they all do very different things and are based in very different regions. Fisher & Paykel is a good example of one that literally doesn't move in any way relative to the rest of the portfolio. It is a New Zealand-based, as I said, producer of breathing equipment such as respirators and masks that help sleep apnea at night. Now, this has had quite some cycle going through COVID, making respirators. You can imagine that in 2020, they had so much demand that the senior management team told me that they even left the headquarters office and went down to the manufacturing floor to help their colleagues pick and pack products to send to hospital around the world. I find it quite impressive when the CEO of a company is willing to start packing products and get them out the door. Now, obviously, after 2020, they sold so many respirators that some of their people told them, we're probably not going to do this again for several years. But the good thing about Fisher & Paykel is their most profitable sales come from consumables. Every time someone in a hospital needs to use one of their respirators, you need to change every element of that respirator that touches the patient. And that is the consumable business that continues to grow because of the new enormous base of respirators that were installed during COVID. So why is now a good time to be investing in small companies? Well, we all know what's happened to large companies over the last few years, particularly the biggest, the Magnificent Seven. Well, sadly for us, the small caps have been left behind. Small companies over the last 7-8 years have consistently underperformed that of large caps. And not dissimilar to emerging markets, funnily enough, the last cycle peaked for large caps, as we know, in 2000 at the dot-com bubble, which is exactly when small caps troughed relative. After that, we had a fantastic run of 15 to 18 years. Since 2018, however, that cycle has reversed. But what it does mean is valuations are now looking, on the whole, extremely attractive. So again, the valuations of small cap relative to large cap. So below the line, small caps are cheap. The last trough in small cap valuations was again around that dot-com boom, peaked around 2011, 2012, and is now almost back to those extreme levels during the dot-com boom. So we feel not only from the macro level, but anecdotally, everywhere I am looking, we are seeing opportunities. In all honesty, I think currently there are more opportunities in small cap than we have capital. There are just more and more of these great companies reaching valuation levels that we are extremely excited about. Now, there are two questions that you should always ask anyone that stands in front of you with an investment proposition. The first one is, does it work? Yes, it does work. Since 2018, our inception, we've only had one down year, which means that we've compounded over the period since inception at 9%. We have also had a reasonable start to 2025, although I have to warn you, March has been horrible. But we're very optimistic about that continuing. And the final point is that we have healthily outperformed our small cap peers at the lower chart there. Now, the second question you should always ask someone who's giving you an investment proposition is, do you own it? I own a lot of it. So this is my personal investment portfolio. In fact, we own so much of it, my wife is even in the audience, just to make sure I'm still doing what I said I was doing. Smithson accounts for over 70% of my personal investment portfolio. And if you fear that this may only be the sum of a few £100s, I can assure you that holding in Smithson is worth substantially more than my house. So I love this quote from Nassim Nicholas Taleb. If you don't know him, he's an ex-portfolio manager turned author. He has fantastic books, several, I recommend them all. But he's this great quote, don't just tell me what you think, tell me what you actually have in your portfolio. This is what I own. Thank you.
Terrific. Okay, do you have any questions for Simon, please? Do you have a question at the front down here, please, Chris?
Thank you very much for a very cogent presentation that reminds me of one I heard from Terry Smith in 2013, which caused me to invest in his fund at the time. I have two questions. Firstly, you have to run winners to a degree, and if I look at the 5-year performance, which is a kind of the benchmark I use most, I would have had a double return from Mr. Smith's original effort than I would have had from your own. And I take the comment about large and small companies, but you actually have to go with the winners, in my view. I'm also slightly confused by your definition of a small company, in that in about 1996 or 97, I bought Halma at £1.56, at which time it was a smallish or medium-sized at any rate company. The shares are now £26.50 and have danced around 30 or more, so I'm not unhappy with that investment. But I struggle to see it as being a small company where the market cap is now 10 billion, just under, fractionally under today. Where do you draw the line and decide that you would better deploy your capital from a large company into the target of small companies that are going to grow?
Yes.
Because Halma doesn't seem to be in line with the stated philosophy.
No, we're still running that winner. So Halma, I agree with you. It is getting bigger and bigger, which is good for us. But ultimately speaking, the way that we think about it is it would be stupid to have an artificial hurdle above which we have to give up one of these great companies, bearing in mind how hard it is for us to find these great companies that we want to hold on to and compound until they become big companies. Now, to give you the most recent example, Fortinet is a company that we sold that we finally realized was too big for us. And we realized that because, as we all know, investing is a relative game. If you take capital from somewhere, you need to put it somewhere else. And so for Fortinet, we realized we could buy a much more exciting, faster growing, could I go backwards?
Should work.
We could sell Fortinet to buy a much smaller, faster growing company. And so it was that relative attraction of the smaller company to Fortinet that we decided to sell it. But Fortinet had got extremely big then, and that's why we decided to sell. But Halma, we will continue to own as long as it continues to perform. And actually, some of its best performance in the last couple of years has come just recently. So for us, we're glad we held on.
So what would be the smallest end where would you start? What's the threshold of your investment
Our
universe?
current low-end threshold is £500 million.
500 million. And you don't have a ceiling, as you explained. You might keep holding something, but when would you take a new investment? What would the new entry point be at?
Currently, the top-end ceiling of a new investment is £15 billion.
15 billion, okay. Any other questions for Simon? Question here, please, thank you.
Hi, first one is very quick. Financials, can you give a couple of examples of your holdings? And secondly, sector distribution-wise, especially with the concentration on industrials, how do you manage any potential concentration risk?
Generally, we don't invest in financials. We have one holding in financials, which is actually MSCI, the index company. So the reason we don't like financials in general is because they tend to require a lot of leverage to make it even an adequate return. So obviously when something goes wrong, as we've seen multiple times through history, it becomes a disaster. And we just don't want to take that risk in a very concentrated portfolio. Your second question was regarding industrials. We do have about 40% of the portfolio in industrials, but I would caution that there are several extremely different businesses within that very broadly described, which is described by MSCI as it happens, GICS sector labeling. So just to give you a couple of examples, we've got Halma there, which we've just discussed, Rationale 2, but Verisk is a data business. Verisk, and this is a great business because it is specializing in the insurance industry, and they link to all the insurers in the US and increasingly throughout the world, and they receive insurance data for free. They take all of the claims data, all of the underwriting data, everything they take from their clients for free. They repackage that data and resell them back to the same insurance companies for a price with some software overlaid. It is an amazing business, increasingly high return on capital. Not so exciting in terms of growth, tends to be high single-digit, low double-digit growth, but when a company like that is so simple, so established, and such a dominant position, it is one for us. And then finally, Monotaro, so different again. This is a Japanese business, and it is in the MRO industry, which is maintenance, repair, operations equipment, but which is not particularly exciting, but it is exciting because it is the only or largest online operator of the MRO industry in Japan, which is way behind on the adoption of the internet in terms of MRO. In fact, only 20% of the industry is online, and Monotaro is accruing all of the additional growth there, therefore growing in the high teens. But none of those share a business cycle.
Question here, please. Yeah, thank you.
It's interesting you say one of your policies is to do nothing, but with Liberation Day coming in a day or two, is it still wise to have 51% in the US when Europe and the UK small caps seem to be much better value with P2Es much lower?
Yes, listen, Trump has caused absolute turmoil in the global markets, and it's affected not only the US but all global markets. You know, Europe over the last few weeks has outperformed the US, but it's still down. You know, the whole market is down. So what's interesting with small caps is that US-based small caps tend to be quite domestically focused. The beauty of small caps is they're operating in geographical or industry niches. And so our small companies in the US, the vast majority of which only operate in the US, and many, like Verisk, like SSON, which we don't have on here, but many don't have any type of goods coming in from outside, and they certainly don't have any customers outside. So actually, a lot of these companies, because they're small, because they're still growing within their domestic market, are very insulated from those tariff concerns.
Lovely. Okay, Simon, thank you very much indeed. I think we're going to stop there. Our next presenter...